मैं लाइव जा रहा हूँ. Yeah. Awesome. Arey Vikas bhai, Vinod is there. Awesome. Awesome. Great. Vinod, you are able to hear me?
I am, Ardeep. You actually make me nervous when you attend such kind of seminars. Thank you so much for attending.
Awesome. It's been Amardeep is from Delhi, right? Arey, Amardeep, if you can just come and chat for a couple of minutes, will that be fine with you? Lita is not able to listen to us.
Cool.
Okay. Saurabh, can you just share your screen? Yeah. Okay. Rajesh bhai is also here. क्या बात है? No, they are fully, attendees are fully, there are so many veterans here today. So, okay. So thank you everybody, taking your time out on Thursday evening. Really, means a lot. Exactly. So the topic for today is, when to exit an investment. I think, Saurabh, it's a very interesting topic because we all, really figure out कि entry कभी करना है, hold करना है, buy करना है, but exiting is like more, it's something, a very, very gray area for most of us. So it's going to be a very interesting session, listening to Saurabh and so for a very long time, at Circle Wealth Advisors, Mukul, Saurabh and I usually discuss a lot about, when should we exit? When should we, is it the right time? Is it not? So we keep on discussing that. So today in this webinar, what you're going to get is our year's worth of, discussions, packed in a smaller size from Saurabh in just, probably an hour or something. He'll give you the gist of what we discuss probably on an ongoing basis. There are a lot of times when we use our travel time towards our client meetings or industry related meetings, discussing कि अभी exit करना चाहिए, नहीं करना चाहिए, क्या लग रहा है, कैसा लग रहा है. It's a long conversations that we have. So before I talk about the overview and hand it over to Saurabh, I think let me introduce a bit about Saurabh first. He's been in this industry for I think over 20 years now, so quite the veteran that I would say. He regularly writes for a lot of magazines, media. He gets quoted a lot in Economic Times, Business Standard. He comes on radio every day with Rishi K. Right from 8 a.m. to 10 a.m. Or sometimes even twice or thrice a day you'll hear him while you're traveling to your office. It's just super good to have those personal finance nuggets of 3 minutes, power packed nuggets as we say, that he shares with the listeners. I think and over a course of time in the Circle Wealth Advisors firm, he's built it from scratch, and he's quite instrumental in terms of understanding the product, understanding the investments, understanding the conditions. So I think we are in the safest hands today. Even I am as excited to listen to Saurabh's views, power packed into 1 hour session as all of you guys are. So let me start with a brief overview of what Saurabh is going to cover in the next 1 hour. So first of all, he's going to talk about what does exit really mean and why it should be strategized, internal, and then what are the conditions basically that drive a person to or drive a metric towards an exit. Probably it's an internal condition or a product attribute, market attribute, strategy, and what stops people from taking the right exit. So these are the things that he's going to share with us. There is a few interesting data points that he's going to talk. Quite really interesting. Even I'm quite excited to learn about those data points in detail today. So before so let's start with the poll. The poll is, what conditions make you think to exit an investment? So I'll just launch that poll. Okay. So what conditions trigger the action to exit an investment? So it's a multiple choice question. You don't need to just click one. If there is more than one, like if you need money, if the returns are below expected, if there's a future outlook, better opportunity or something, or anything else. I mean, if there is anything else, you can just tell us, raise your hand. We'll be happy to have you, share your experience with us, or share your personal, reason why, what triggers you to exit that investment. I think that's quite a comprehensive set of numbers quite early, Saurabh, today. The audience is quite engaging. You'll really enjoy today. Okay. Oh, okay. Ulas has already raised his hand. Just a second, Ulas. Okay, last 10-15 seconds for those who haven't voted.
I think we already have 76% people voting. So
yeah, I was just thinking if the rest of the 24% also jumps in. All right. Also, I'll just end the poll and Ulas will come to you. I'll share the numbers. So this is it. 54% Saurabh says that they need money. 38% say कि returns नहीं आया, returns कम आया. 15% talk about कि future में नहीं लग रहा है या फिर क्या लग रहा है. Product or shortcomings are 31%, and if there's a better opportunity, surprisingly better opportunity is 50%. So I guess we're going to have a lot of quite interesting stats today. Okay. So Ulas, I'll just unmute you. I'll allow you to talk. You can unmute yourself. Ulas, can you please unmute yourself? Yeah.
Yeah.
Yes. Hi, Ulas.
Hi.
Yeah. Please share.
Retiree person always searches better opportunity for investment.
Okay.
That is my problem.
Brilliant. That's brilliant.
To have a good income.
Yes. Awesome. Okay. Thank you so much for sharing.
Awesome. So
yes, sir. Over to you.
Okay. Thanks a lot, Jinay. Thank you so much. We wanted to actually, by taking this poll, actually we wanted to risk ourselves because, we don't know what, the audience is going through, and it can be a completely different. Like I was very, I was hoping that people would say that, people want to exit because they foresee something happening in the future, and because of future outlook, they would want to exit. And surprisingly, that's a comparatively very low number. And obviously, people are looking for constant opportunities and would want to, switch products or investments and exit from the existing ones in want of for better returns or a better opportunity. So let's try and see. I hope next 45 minutes or so, I'm able to add complete value to your time and do justice to this topic. It's a huge topic by its all mean because, like we've been saying that so many things have been written about when to enter and when to invest, but exit is equally important. And even if you search on net, there's hardly any worthwhile stuff that you might find, which you feel will really be able to help you in determining as to what really helps you in taking that decision. So this is my attempt that obviously it will not be as extensive, but it's my attempt to let's try and summarize and at least give some few actionable points so that we can start strategizing our exits. I would want to keep a lot of question answers. I mean, I hope there are a lot of question answers and good interactions that happen. So I'll try and finish the presentation as soon as possible so that we can engage in more interesting questions. So let us start with a very basic thing. What does exit really mean? I mean, this is how we look at it as an investor as well as a financial planner. Most of the time, people feel कि मुझे market खराब लग रहा था या ये stock का भाव बढ़ गया या कम हो गया इसके लिए we have exited. But that is only a part meaning of exit. In our parlance, what we would like to think exit actually means is, one is that like a lot of people have said that when you exit when you need money, right? So the ultimate of what is the ultimate aim of investment is to use that money for the financial goal for which you have invested, right? So ideal exit would be when you are exiting your investments to consume that money. So if you have invested for buying, say, a property or a car or for your financial freedom or for your child's education, the best time to exit would be, the best worth for your exit. The effort of all your investment is actually paid off, and now you are exiting to consume that financial goal. I think that is the ideal scenario for exiting. But you also have to understand that when you actually take an action to exit, it has certain impacts on your other aspects of investment. So one is that it changes your portfolio composition, right? So if I'm say, for example, invested 20% in equity, and for whatever reason I sell 5% or 10%, it will actually change my portfolio composition. So the asset weight will actually move. So when I'm selling, I not only have to look it from that particular investment point of view, but also how it is overall impacting my portfolio composition. Second thing, you have to remember that every exit means an simultaneous entry, right? So when you are exiting from one product, you are actually investing in some other product. So it goes hand in hand, right? It is switching from one investment to other investment. So whenever you are exiting, you also have to be very, very clear as to where that money is going, if at all you are not exiting for consumption of your goal. Third thing is that when you exit, it also leads to an opportunity cost, right? So although we don't encourage people to do that, but people often look at that if I had stayed invested in that particular investment, what would have been that worth? So if I exit an investment today, and after a year that particular investment gives a phenomenal return, and I didn't participate in that up move, that means I've paid that opportunity cost by exiting at a wrong time. And lastly, one another way of looking at exit is that if I really want to consolidate all my investment, like if I'm invested in too many products and it's too scattered, then I exit just to consolidate. So coming back to the poll that we did, I would like to think that everything that we mentioned, or any other thing that you would see that would trigger your want to take an action to exit from an investment strategy, can be for one of these three reasons. First reason being your internal conditions have changed, right? So we're going to talk about it. So something in my scenario or my own conditions have changed, and that is why I need to exit an investment. Second is something in product attribute has changed, or I have realized that something was not I was not aware of. Like we said that you realize after being invested in certain product that this product is not worth to continue, and then you would want to exit that product. So it is just maybe because you realize that product, or the attributes of those products have changed, maybe because of taxation, maybe because of whatever dynamics that company was going through. And lastly, which I think, which I would want to believe that a lot of people who want to exit is what happens externally, what is a market conditions. So I would want to believe that any exit strategy will be triggered by any of these three things. So there's nothing more to that. So either something changes internally, something changes externally, or there's a change in product attribute. So I'm just going to cover these things very quickly and understand what is it that we can do so that we can strategize all these things. So changes in internal conditions. This is one single slide on internal condition. So what would happen? What would trigger so that you would have to exit an investment? So we've been discussing, the first and foremost thing is that you've reached your goal. Second is that there's an internal change. So, in pandemic, we have seen that people have experienced there is a considerable cut in income. On that income change would lead to exit into certain kind of investments or change in portfolio composition. So internal condition, and so would happen if your income rises considerably from current levels. So change in income status might lead to an exit from investment. Change in risk profile, kind of risk that I would want to take on a particular investment or on an investment that I've done for a particular goal. So if that risk profile changes, I would want to exit an investment. Changes in liquidity or regular income needs. So people have regular income needs in that I want a specific income to be coming from my investment month on month basis. If that need changes, or if you suddenly feel that I need the liquidity and I need money to be available as and when I want for whatever reason it may be, if those needs changes, that is again an internal condition which is in and which might encourage you to exit a particular investment. And lastly, like I've said, that if there are too many holdings and you want to do consolidation, so there is nothing changed as such, but it's becoming difficult for you to track so many investments, and you decide to exit an investment just for on the basis of just because you want to consolidate. So these are the things that might happen when you want to, which might trigger an exit from an investment specifically based on internal conditions. So I just want to give you a case study of what can happen, when you are not aware or ready to make changes when your goals are coming closer. So this is a very, I can say it's a very, very extreme case. I don't know. I'm sure a lot of people would have not experienced it, but these are pure true numbers, right? This is an experience of an investor who might have invested in Nifty month on month from March 2010 to March 2020. Now we all have heard that invest in a SIP for a long term and you would mostly make money. And I am also saying that this might be an extreme example, but this is what has happened. This can actually be an experience of an investor like you. So if someone would have started an SIP on 23rd March 2010 and he would have invested 10,000 rupees, obviously the value is 10,000 rupees. Next month, it becomes 20,000 rupees and the value would have gone to 20,151. So there was a profit of 151. After 2 years, 2 years and 2 months, on 23rd May 12, 2 years and 3 months, on the 27th installment, the investment would have been 2,70,000 rupees, but it was negative and the value was 2,44,000 rupees. And there was a profit loss of 25,000 rupees. So and so forth. On January 2018, 9,50,000 was invested. The value was 15,83,000 rupees and the profit was 6,33,000. Now imagine if the investor had a goal exactly at after 10 years in March 2020, for which he would have started invested, and he just stayed invested and continued to do SIP. This is what happened to him. 12 lakh rupees invested after 10 years just went down to 12,56,000, and the profit was only 56,000, which calculates to only 1% IRR for whole 10 years of holding period, right? The assumptions that the person would actually reach his goals are completely out of window, and definitely he's just above his capital invested, and virtually he has completely lost money to inflation. So this is what can happen if you don't realign your portfolio or investments according to your goals. So this is what we propose to do, that very, very simple. We don't want to give complex strategies, at least in these cases. So very, very simple thing what we have again studied is that all you have to do is that if your goal is coming closer, ideally if your goal is just 2 years ahead, you should start moving your money to a fixed income fund. So from an equity investment that you have been doing, start shifting your money. So, and very simple. So suppose if you have accumulated 24 lakh rupees and you know that next 24 months are left, you just start switching 1 lakh rupees every month from an equity fund to a debt fund. Now what we did was, how do we know whether this really works out or not? So what we did was that we did a 10-year rolling study from 1995, when Nifty was formed, up until July 2020, right? So any 10-year period that you can imagine is been recorded here. Okay. Uh, every single day when a person would have started SIP, right? It's a humongous data. Every single day from 3rd November 1995, what would have been an SIP experience for 10 years? If the same person would have started an SIP on 4th November 1995, very next day, then what would have been experience? So for every single day from 1995, for July 2020, the SIP would have started on 31st July 2010, right? So from 1995 to 2010, 10-year SIP has been done, what would have been the experience? So if it is a standalone SIP where you don't wish to switch to a fixed income when when only 2 years are left for your goals, your maximum returns could have been 27%, but your average would have been 14%. But if you decide to follow this strategy where you start switching money when only 2 years are left, your minimum would obviously fall down to 22, but look at your average. Your average doesn't really matter. It still holds to 13%. But the best thing, what we saw, where your minimum return can go down to even 1%, here your minimum stands at 9%. So even in this case, where the person would have just made a 1% return, if he would have started shifting his corpus 2 years back, which is in March 2018, and shifted money gradually to a fixed income fund, and even did his future contribution to a fixed income fund, he would have actually ended up making a 9% return instead of just maybe a 1%, where he's not even able to beat inflation. So this is what we need to understand, that at least for when you have invested in equities for a long term, and you know that you have invested for a particular goal, make sure that when 2 years are left for your goals, and this is what we have kind of figured out, and I think it works well for us. You might choose to have 2 years, 1 year, whatever it is, but definitely does not make sense to hold equity right until the end. Start switching your money on a systematic manner. This is what we've called SIP versus SIP with STP. So last 2 years, the STP happened and systematically money was switched from an equity fund to a debt fund. This is what at least back-tested data suggests us to do. So this was the first part of it. What happens? What needs to be done if there is a change in the internal conditions? Now let's talk quickly about what are the product attributes that we can look at if you want to exit certain products. So if there is a change in product attributes, we definitely need to exit. But the question is, what are those attributes that we should look at? What are the parameters that we should look at which will enable us to decide whether we should exit a particular investment or not? So first thing is constant underperformance. But you have to remember that underperformance should not be underperformance from your expectation. Some investments being volatile, especially equity investments, can always underperform for a short period of time because of market conditions. But if your fund is constantly underperforming your benchmark, then obviously it makes sense to probably exit that mutual fund. So don't look at one period. So today, if you look and you say that, okay, last 3 year, 5 year return or 1 year return is underperforming a benchmark, then I should exit. Again, that would not be a right strategy. Ideal thing to do would be to look at either rolling period return, or if not, at least look at calendar year return. So what happened in 2016, what happened in 2017, 18, 19, 20, so on and so forth. I'm not saying that you have to wait for 4 or 5 years, but at least, even if you look at it out of quarter wise, and if you see that your fund has been underperforming for more than a year, then maybe you can take a decision to exit that mutual fund. Similarly, another very important parameter to consider is if there is a huge change in the expense ratio of the fund or the exit load. Fortunately for us, SEBI is very, very vigilant on how expense ratios are charged in funds, and they have kept a stringent control and cap on what the expense ratio should be. But still, we have experienced that there can be huge change in expense ratio. So if you feel that your fund expense ratio is changing constantly, or they've increased it tremendously, maybe you can exit those funds. And similarly, if you feel that the fund has changed the exit load, your new investments can stop. You might not necessarily have to exit it, because the exit load will be applicable only on the new investments. On the old investment, the exit load will be applicable as per the conditions which were prevailing at your time of investment. But if you think the company has made exit load more stringent, maybe you can stop, contributing new money to that particular fund. Another thing is change in a fund manager. So if you feel that a fund, if they're constantly changing fund managers, one fund managers change their co-fund managers who are multiple fund managers who are managing some, and there's a lot of in and out which is going on. I think it can attribute to it can really impact the returns of the portfolio of the fund. So if you see there is a change in fund management, or there is a change in fund management style, there are growth, value, hybrid kind of styles. There are various kind of styles, and if you feel that the fund management style is being changed constantly, maybe that can also be a trigger to exit a mutual fund. Fourth point is change in size of fund. Again, it is a very, very subjective kind of call, but we feel that if your fund size has grown enormously, especially if it is a very small cap fund, small cap or a mid cap kind of fund, we feel that it becomes more and more difficult for the fund manager to kind of continue to generate alpha, because invariably the number of companies in which he's invested will keep on going up. So if you see that the size of your fund, especially in equity fund, probably in debt fund it could be a good thing, but if it is an equity fund and if you see the fund size is going constantly high, then probably it is a parameter that you need to consider. And similarly in debt fund, on the other side, if you see that the AUM is going down significantly month on month basis, then maybe it's a good time to exit your debt mutual fund. Fourth is that at times we have seen that people do accumulate funds which have been advised or offered by various intermediaries, and also because of certain conditions, in 2018 SEBI had changed the um, categorization of funds. So for whatever reason, if you see that you have multiple funds in the same category, then there will be a huge overlap of holding and it might not make sense to continue to hold multiple funds. So you can get down to what exactly your funds are holding. And if you see that there is a huge overlap, then probably that's one parameter to exit a fund. And in specifically in debt mutual fund, again, we again it's very subjective. We are of a thought that it does not really make sense to take risk in fixed income investment, because the opportunity to make investments are not much higher. But if the risk actually plays out, if there is a credit risk, it can actually lead to huge kind of impact. We have seen what has happened in Franklin Templeton and what happened with DHFL papers and ILFS papers and so on and so forth. So it's better that when you invest, you look at the paper, the fund is not invested in risky papers. And similarly, that is one other parameter that you can track. And if your fund continues to hold high credit rating for the schemes, for the papers in which they are investing. So this is as far as mutual fund is concerned. Again, quickly, equity is a complete Pandora box. If you are someone who's a direct equity investor, it is expected out of you that you know when to exit, right? I mean, this is something which should not really add value to you. It is expected out of you that you are taking a conscious decision. You know that you are buying a business, you want to stay in that business for certain reasons. So it is expected out of you that you would know when to exit that particular equity. But just for the sake of discussion, let me just point out a few points which I think are very, very important. So first, like I said, that you should know why you have invested in that company. What is it that you like about that company? What is it that gives that company that edge, that out of those 4,000 listed companies that are available in market, you chose to invest in those selected few 12, 15, 20 companies. Second is, so once you know that if there is a change in business, right? We all heard, about last year that there was one logistic company which decided to venture into air business, transportation business, aeroplane business, So, and the stocks just plummeted down. So if there's a change in business, it's a big red flag as to why this company is venturing into completely different business, and if they have an experience for that or not. Third is that if you have invested and you know why you invested, as soon as you realize that the investment thesis on which you invested is flawed, I think you should just immediately, sorry for the spelling mistake, it's FLAWED. So if it's a flawed investment thesis, you should immediately exit that company. Also, a lot of things happen which can impact the profitability of company. So if you think there is a change in a government policy, or there is a change in a competitor's policy which can severely impact, those are the things that you should track and try and see if it's a good time to exit that company. So we all know what happened in 2018-19, where a lot of chemical companies and graphite companies suddenly went up because of change in the government policy of China. So the way it can go up, similarly it can also go down. Uh, Next thing is understanding what is the weight of that stock in your portfolio. Again, you need to constantly look at from a portfolio perspective. If one of your stock has been really outperforming and the weightage goes up to maybe say 12, 15, 20%, then you would need to exit the stock and trim down the position if that makes you uncomfortable. And last is, if again you have decided what the fair value of that company is, and the valuations are extremely high with respect to a foreseeable future cash flow, then again I think it's a good parameter to take into account and exit equity. We all know what happened with telecom companies in 2000, what happened with infrastructure companies in 2008, where valuations were so rich that it took more than 8 years, 10 years for those companies to again come back to those similar valuation levels. So again, I would say that this is just to bring out highlight the points that as an equity investor you should know. But as in direct equity investor, I think it is expected out of you to enter into a particular stock with a complete exit strategy. So we have covered what should be done if there is a change in internal market condition. What are the product attributes that we can look? Last on that, not too much to say. We have spoken about equity and debt as asset classes. Fixed income, when you have fixed deposits and all, I don't think you need really a fixed. You need a strategy to exit. But there are other asset classes like gold and real estate which we invest, and obviously wanted to cover it. But honestly, ideally, what we feel is that you should exit any particular asset class based on the asset allocation weightage that you want to give. Suppose if I want to give a weightage of say 15% to gold in my portfolio, then on an annual basis, I would just keep on rebalancing my portfolio and bringing it to 15%. So if it has gone up considerably, I would sell it and bring it to 15%. If it has gone down, then I would reinvest and bring it to 15%. So ideally, it should be done on asset allocation basis. But sadly, it is easier said than done. To an extent, it is still possible in gold, but I think it's very, very difficult to do it in real estate. Sadly, in my knowledge, I could not find any simple metrics which can help me in determining whether gold prices are really high or they're below average or something like that. Same goes with real estate. So there was no universal metrics. And what I feel that ultimately it boils down to your internal condition, whether it is in terms of your asset allocation or your liquidity requirement or the goals that you have invested for. So with this, we've covered two aspects of exiting an investment. One is changes in internal condition, and second is changes in product attributes. Now let's go on to the third and most talked about. People do talk about what's going to happen in the market, and can we exit and buy later at a lower price and not. So what are the things that might happen in market conditions that might eventually lead to exiting a investment? Before I do that, I just want to take a quick poll and understand what do you feel. So Jinay, can you start the poll?
Yes, just doing that.
So there are two investment opportunities. You invested rupees 100 each in company A and company B in equities. After a year, company A's stocks are worth rupees 80 and company B stocks worth rupees 120. After 1 year, you need 20 rupees today, right? So which company would you sell so that you can take the 20 rupees with you? we have 62% people voted. I would really encourage people to vote. I mean, it's a very simple question. Nothing right and wrong. It's subjective. You have two stocks which is worth 80 and 120 today. Both of them started with 100 rupees. You want 20 rupees. Which company share will you buy to generate the 20 rupees cash flow for you?
So last 10 to 15 seconds before I close the poll.
Yeah, Jin, let's go ahead.
Oh,
So some 25% people just don't want to participate, I guess. Cool. So I think
60-40.
very good. I think that one of the reasons that we have received 60% in company A is because I know a lot of people are from the industry and they know how it works and how it can really impact. But at the same time, there are 40% people who feel that it's better to book profits and take the 20 rupees. And I think that these are the questions that you might be facing time and again if you kind of keep on looking at what market conditions have changed and how do I keep on taking money based on price movement, right? So this is an ever confusing and biggest question that all of us face. You've shared the results, right? You've shared the results, right? Okay.
Yes, I've shared the result. It's 60-40.
Let's go ahead. So this is what happens, right? We know this ever pervasive question, "Su lage che?" Market kya lagta hai? Channels and medias and newspapers do try to predict that. People try to predict what's going to happen next 1 hour, 1 day, 1 year, and it just kind of dazzles me. And all of us want to know that what will change in market, which will help me in making better returns. Sadly, even the world's best investor, I mean the most renowned investor, can only give us a direction and not a true right answer to it. So we know this famous quote from Warren Buffett that be fearful when everyone else is greedy, and be greedy when others are fearful. And honestly, uh, to tell you, I mean, it's easier said than done, right? Not only from a perspective that you have to really stand and take a contra call, but also to really understand. I mean, at times it becomes difficult. Ki actually, mein chal kya raha hai? Are people fearful or are people greedy? What has specifically happened last 1.5, 2 years? It's really difficult to really understand and try to say that okay, this is where the whole market is standing, and I'm going to take a contra call and do exactly opposite what people are doing. This is what happens, if we my point is that this if we don't have a clear outlook, uh, ideally we would want to buy here and sell here, right? You would want to sell high and buy at a lower price. But we have seen that in market, and there are enormous amount of studies which have been done that an average investor's return is much, much lower than the investment return. And that is purely because of this behavior where people chase good returns, better returns, and generally happens because of recency bias, right? So a lot of people are talking about gold now. 2 years, 3 years back, everyone was talking about cryptocurrency. And when something has really gone up, like today, pharma is really talk of the town in terms of equity investment. So people try to chase the best next trend, but it happens generally that the trend has really played out, and when we as investor want to get in, we burn our hands. So what is it that we can do again so that we are not stressed with this kind of situation and we don't fall in this trap? Because like this image says, if we keep on doing that, ultimately we'll end up being broke. So, uh, you know, uh, what I'm trying to propose here is that let's try and create a strategy for ourselves and let those parameters be uh, a guiding light for us to understand whether what should be my next movement. Should I really exit my investments specifically in terms of equity, or should I continue to hold them? What is the risk to reward ratio that I am holding when I continue to hold this investment? Also, to remember that this is the beauty of market, right? Whatever stocks you're holding, every day market comes to your door and knocks whether you want to sell your stocks or not, and you are choosing to say no when you are not selling, right? So every day you had an option to exit, but if you are not exiting, that means you are buying on every single day, right? So every single day's decision has to be dependent on a particular tool or track, or on a tool that you can track for you to understand whether you should continue to hold that investment, should you sell partly or fully, so that the risk reward is in your favor. So let's look at these popular tracking tools which are there in the market. This is not obviously an exhaustive list. There are a lot of things that people do, and this is everyone's dream to crack the code where you can uh, buy at the bottom or at the low levels and eventually sell at the higher levels. We feel that it should only be given the weightage uh, as much as deserves. The bigger weightage should be, or the equal weightage at least, if not bigger, should be given to your internal conditions and your uh, product attributes. That is why we have kept this in the last, although it is a more extensive kind of thing. But we feel that your focus should not be much more on this, but it should be equally, if not more, on the other aspects of exiting, which is internal conditions and changes in product attributes. So these are very popular tracking tools. Price to earning ratio. Price to earning ratio is the price that I'm paying for every rupee that the company is earning for me. So this is price to earning ratio. Price to book ratio is again what is the book size of the company, what is the kind of capital that they've deployed, the assets that they have, and what is the price I'm paying for that book. Dividend yield is to track as to what is the yield that I'm getting on every 100 rupees that I've invested. uh, uh, Price to earning ratio and price to book ratio have a certain mean, and we're going to talk about that, which can give us an idea as to what whether the market is overbought or oversold. Same thing happens with dividend yield, but it also depends on if you again you have to remember that these tools might not necessarily be useful for you to trade in a particular stock. This is just for you to gauge a macro look from a bird's eye view as to if you are holding an equity, whether the risk reward is in your favor or not. So, dividend yield is the yield that you get by the dividend which is paid by the company. Then there's a not so popular, but again, it's a very interesting ratio called yield gap ratio, which talks about what is the difference between the yield that you're getting from equities and the interest that you're getting on a risk-free investment. So depending on what that gap is, people track their investments. Next is this ratio was made very, very popular by Warren Buffett himself. What is the market cap to GDP ratio? Ideally, 1:1 ratio is considered to be expensive. If it is less than 1, it is considered to be cheap. If it's 1 or more, obviously it's considered to be expensive. So what is the total market cap and what is the total GDP ratio? I not tracking it very aggressively, but from what I remember, it is almost close to 1 right now. And lastly, some people use technical analysis for this. There are 200-day moving averages, 50-day moving averages, and so on and so forth. I am not a fan of technical analysis. I hardly know anything about it. But just to bring forth another tracking tool that people use extensively is technical analysis, whether again it is on a stock or an overall benchmark. So, there's this famous saying that don't ask the person his view, but look what he is actually doing in his portfolio. So I really want to now take you to what we have been doing and talk a little bit about P ratio and how we are using it to manage money for ourselves and for our clients, which will give you a clear picture as to how we exit our investments, specifically when it is considered to when it is related to equity mutual fund. So this is a phenomenal graph. It is a graph of Nifty P, trading Nifty P, and you can historically from 1999 right until yesterday. So this is how PE has actually moved, right? This dark yellow zone, I hope you can see this, is the is what we can say a zone which is to be considered as a fair value. So the long-term average of PE, the long-term median is 20.14. It's very, very feebly visible. It's 20.14. So this dotted line basically denotes that what is the long-term average. Now, if the valuations are above this dotted line, it is understood that markets are expensive, and if it is below this dotted line, it means the markets are on the cheaper side. This is what has been the trend since till now. We all see what has happened in 2007-8 when P went, and these are bands which are created on the standard deviation of P. You don't need to understand that, but just understand that these are various bands. As it goes darker and darker, that means it is getting more and more expensive. And as it is getting lighter and lighter, that means it's getting cheaper and cheaper. So more towards red is more expensive, more towards green is more cheap in terms of the valuations. So you can see what happened in 2007-8. It almost touched this pinkish line, and then eventually it fell and went right to the bottom. Since last almost 2.5, 3 years, market has been trading in this above yellow zone. I don't know which color to tell it is, but it is an above yellow zone and below pinkish zone. Just before the crash in March, it was at this level, and then eventually it fell. It went below the dotted line, right? It didn't cross the yellow zone towards green zone, and then we all know since then market has just shot up phenomenally. And as on yesterday, the P multiple is 32.64, which is highest ever recorded in the history of Nifty, right? So it's almost touching the dark red zone, which is at 32.84. So if Nifty goes, if the P goes up by another 20 bips, we'll be in that dark red zone. Now, it's again easier to constitute this information. We also have to understand how do we really use it. But just to give you another perspective to it before I go to that is that average P is 20. That means for every 1 rupee that the companies in Nifty are earning, the average price that we tend to pay is 20 rupees. Today, if we are buying, and remember what I said to you, that if you're not selling, you're buying again today. Today, if you're buying, for that same 1 rupee of earning, we are paying 32.64. So it's almost 50% higher than the average, right? So what we did is that we find this very, very fascinating, and we have developed a strategy around this completely. This is a back testing of this strategy right until from 2004 till 2020 again. And this blue line is the same P line, right? Where it went up and went down. This is 2007-8 period when it went from high to lows. And this orange line is what we have decided our equity allocation should be. So we have created various bands, and this is the backtesting of those bands. So you can see that these are completely opposite, negatively correlated. As the P goes down, the allocation in our equity would go up. And similarly, as P starts to moving up, like it has moved up from year to year, I hope you can see my cursor, our equity allocation has gone down, right up to 0. So we have an option on the right hand side, as you can see, from 0% equity to 100% equity. And as valuations become rich and they are on the higher side, the allocation in equity goes down. And as the valuations goes up, valuation goes down, the allocation in equity goes up. So this is what we did as a back testing and created a strategy for ourselves. And this is the actual result of our strategy. Now, this is an actual portfolio of our client, net of fees, and actual return that he can generate as on 31st July. So this client started, we implemented this strategy for this client in April 2013, and the value of his portfolio was 86,50,000 rupees, just to make it on the round figure side. The current value in our portfolio is 1,95,68,000. The same money was invested in Nifty, its valuation would have been 1,68,50,000. So you can see there is a difference of good almost 25, 27 lakhs on an investment of 86 lakhs, where the profit is 1 crore 9 lakhs here, and here the profit is only 82 lakhs. But more importantly, so which has resulted a return of 11.72 and 9.46. But more importantly, the standard deviation, which is a matrix of what is the volatility that an investor would have faced. The standard deviation of the portfolio is almost half, which is only nine times, while here it is in Nifty it is 17. And it is completely evident from this graph. The green line is the portfolio, and you can see that it is much, much smoother than the blue line, which depicts Nifty. So as you can see on 31st July 2020, just before March, the markets fell and the valuation of clients' portfolio went down from 1 crore 85 lakhs to almost 1 crore 30 lakhs. So in 1 month, one or 1.5, 2 months, client would have lost almost 55 lakh rupees if he would have stayed invested in Nifty. But because of this exit strategies, we were sitting out of equity for almost 2 years. And then when markets fell, obviously our portfolio did not fall as much, and eventually we started buying, and we were considerably invested in equity. And again, as markets rebound, so did the portfolio. And as you can see that after every market cycle, when market falls, there is a considerable gap, and then eventually this gap would be sustained. If markets now today again we are zero equity, just to tell you, because like you said, the valuations are so rich. So if again if market continues to go up, we might underperform, but it's completely okay because it gives a much better experience to an investor. So again, just to summarize, how do you really create a strategy for yourself? The point was not to tell about our strategy, but because we have been reaping benefits of this strategy, what I want to tell you is that what are the things that you can do so that you can create an exit strategy for yourself. So first is decide the points of exit when you invest, right? You should, whether it is in whatever investment that you're doing, make a research on various ratios. Like I said, we pointed out so many ratios, and decide what appeals to you, what you feel is comfortable, what you feel really can work out. There is always a contradiction. Some people say that P might work out, P might not work out, and so on and so forth. So for various ratios, there are pros and cons. Decide the value on the parameters of the company's performance. While choosing a strategy, consider tax and transaction cost, right? Because we are moving in and out, there would be a tax, there would be a transaction cost to it. Most importantly, once you have created a strategy, be disciplined towards it. I mean, it will keep on challenging you. You will have to answer this question. But if you're clear that you have chosen strategy after doing a great amount of homework, just follow the strategy diligently. And for doing that, for having the discipline and confidence, do an extensive back testing. I know it's very, very easy said than done. It takes humongous efforts. I mean, we have gone through it, but this is all that I have to say, and it's an evolving and learning process. But the point that I'm trying to make is that instead of asking this question again and again, what is going to happen? Should I exit? Should I stay invested? Should I hold, buy? All those things, it's better that you create an exit strategy for yourself so that you can just follow the strategy and reap its benefits. This is my last slide. And I just, the point that I was wondering was that twofold. One is that why is it that people don't talk about exit? Maybe it's because intermediaries are paid when someone is investing and they're not paid when someone is exiting. We are used to that thought process when we are consuming a product. Like when I go and buy a phone, say for example, I would only think about how to buy and which phone to buy, and never think about when do I sell my phone, right? So when we are buying products or services for consumption, there is never a thought of exit. So maybe it's because of that, but that is not how you should look at investment. You always be looking at investment, and when you are buying it, ultimately it's only a means. You will ultimately have to exit that investment so that you can use it for your goals. So that is probably one of the reasons. But we also looked at what could be the reason why people don't take those exits. So like we all know that some people have emotional attachment, like especially in form of jewelry, maybe in sometimes, maybe in case of real estate, that people don't know the kind of opportunity cost that they're paying when they're exiting or not exiting a particular investment. And if you have an emotional attachment to it, I think it's a red flag to it. Another thing is that there's a lack of monitoring, right? It really stops people from taking the right exit action because they don't know. Like I said, if you want to really exit a mutual fund, it is the right thing to do is to monitor your portfolios or your schemes performance on a quarterly basis as respect to the benchmark, and only on that consistent monitoring will you be able to take the right action. There is a huge anchor bias, right? We all saw this poll where at least even now 40% of people, actually there's no right answer to it, but if you are just biased because you don't want to book loss, there's always an anchor bias. And same is with the loss aversion, that you just don't want to book loss. I find it very, very say funny or upsetting, that when you see on TV shows and people ask this typical question, whether should I buy, hold or exit a particular stock, and the specialist or the expert so-called always ask this question कि आपने क्या भाव में खरीदा था. It doesn't really matter, right? If I meet someone on Churchgate station and I ask him where is Gateway of India, he will never ask me कि आप अंधेरी से आए हो कि भाईंदर से आए हो, right? It doesn't matter from where did I start my journey. What is important is where I want to go. So today, if you have a stock, like I said, if you continue to hold it doesn't matter at what price did you buy. You bought it at an X price, doesn't really matter. What is important is that eventually where the price will go and is it worth to hold it in your portfolio. Just to summarize, exit should be planned, not ad hoc, should not be linked to your entry price. It should be completely future oriented, and you should always consider transaction and taxation cost before really taking a decision. Once you have this plan in place, I think life will become much, much more easier. With that, thank you so much. I just want to end up with this last sentence. Exit is equally important to entry in making money. It is the key to unlocking wealth. An effective exit strategy builds confidence, trade management skills, and profitability. Thank you so much.
Awesome, Saurabh. Really fun-filled 1 hour. Okay, so before I drop into the Q&A, and so by the way, if anybody of you want to ask questions, please, use the Q&A box freely. Before that, I'll just start with a couple of questions of mine. So the first question is,
you want to run a feedback or you want to do that later?
Let's run a feedback straight away. Yeah, I'll just run the feedback. So before we get onto the Q&A, let's just take a quick feedback, how the session was.
Yeah, please give your feedback so that it helps us to create good content. We know that whether it's working for you or not, and whether the topic or the time was worthwhile for you or not.
Right. So while the feedback is coming in, I'll just, so the question that I have is, Isaac Newton has said, he can't predict the madness of the crowds. He can predict the movement of the heavenly bodies. And I'll just give our listeners a brief background of what happened in the South Sea company that he had purchased. So he had bought his shares, and for 10 years, nothing happened in that company. And suddenly the shares started to rise. It has been said by the biographer of Isaac Newton that when Newton actually sold those shares, he had around 200 years worth of his income. He had made by that time. So probably it was around 400 pounds or something. I'm not pretty sure. But after that, what happened is, from the most genius man, the stock of South Sea continued to climb up. And then Newton had this feeling of, I fear of missing out. And then he entered the stock again. And after that, the stock suddenly collapsed and it crashed and, burning a hole into Newton's 200 years worth of money. So while, exiting definitely, is quite important. But there are certain things, sometimes these situations happen. And so that's the first part of the question. And the second part of the question is like, like you and I we've gone to a lot of our, client meetings, and we've heard ki yes bank ka kya kare. I wouldn't want you to take the name, but still, the price continues to collapse. But still, there's nobody wants to book a profit, nobody wants to exit from that investment. And why is it, that certain things happen? If you could just throw your light on it.
I mean, it's a completely discussion in itself, it's just not a Q&A, but, I remember this very interesting image by, again, Carl Richards, where he said that probably a few years back, it was better to be a part of the herd and enjoy what everyone else is doing. And it was probably risky to, go against the herd. And today, the things are completely different. If you're being a part of the herd, probably it's very risky and it's better to stand alone, right? And you know what has happened in Yes Bank, that the number of retail folios have just been going up. In this madness to buy a stock just because it has fallen so much that it might again go to the same price without really valuing the company depending on its future earnings and cash flows and NPs and whatever you need to do to assess a bank. People have just been buying based on the price. And that's why I said that as an equity investor, it is expected out of you that you invest with an exit in mind. And that exit, if you're doing just because on price movement, and I'll buy it in X price today and I'll sell it in X plus some profit tomorrow, doesn't really goes well with good equity investing. So that's all to it. One last thing to that is that people feel that if you are investing in a 20 rupee stock, and if you are investing in a say 500 rupee stock, because this is a 20 rupee stock, the risk is less. कि कितना होगा 20 रुपए तो जीरो होएगा जा सकता है 20 रुपए कितना. But when you are investing in a 20 rupee stock and you are investing 1 lakh rupees here, remember, if it goes zero, you lose 1 lakh rupees here. And if you're investing 1 lakh rupees in a 500 rupee stock, again you will lose 1 lakh rupees there. So the loss is not on the price, the loss is the amount that you're investing. So if it is a 20 rupee stock, it can still fall further, right? So if a stock has fallen from 100 to 90, 100 to 10, so a stock can fall 50% after it has fallen 90%, right?
Correct.
From 100 it can go to 10, and again it can fall 50%, and from 10 it can go to 5. So I think chasing falling stocks is a completely different thing, but yeah, I mean, seldomly it pays. Not sure if it pays always, but I've really not seen people being paid handsomely for that.
So, like the PE strategy that you showed, what we had done is by 2017-18, we were completely out of the market because the valuations were quite high.
Correct.
But at that point in time, the market continued to go up. And what was it, that worked for you that you didn't, enter back just because, you already exited once and you didn't enter back? So what was it that for you at that time?
So I think it was this today's webinar that I had to deliver that, you have to stick to your discipline.
Correct.
I mean, you have to walk the talk. I mean, if you consistently make same mistake, probably you'll be right at one point in time, right? बोलते ना बंद घड़ी भी दिन में 2 बार right time बताती है. But if I keep on changing and hopping, if there's no exit perfect strategy, then probably I'll just not end up anywhere. So I mean, there was no rocket science to it. We just felt that we've done extensive backtesting on it. The strategy was implemented in 2013. It worked really well for us up until 2018. And just because now we see an underperformance for a few months, should we really change on that strategy and put a question mark on that? Probably didn't go well with us. Again, I'm saying it's easier said than done. Obviously, it raised a lot of questions, not only amongst ourselves and with our investors. And we kind of try to work and try to see what we can do with our strategy and how we can improve it. But to take an action against our strategy is something we find much more riskier rather than trying to rather than losing some gains on the investments.
Right. Okay. Great. So I'll take the questions from the Q&A box now. So Amit has asked a question, Amit Kajaria, that while shifting funds to fixed income, should the SIP be still going on? So basically what he's trying to say is that exit strategy can be, completely different. मतलब एक fund का एक one-time investment, exit strategy is different, but the SIP is still going on. Can something like that happen?
No, so I think, see what happens, I would like to bring a very important point here. See what happens in SIP when you start investing. right? So suppose if I started 10,000 rupees SIP, after 1 year I've invested 1,20,000 rupees. The ratio of my installment to my corpus is quite high. 10,000 is still about 8% of my corpus, right? So when markets fall, I am happy because I'm able to buy more units at a lower price, right? Over a period of time, the ratio would become significantly lower. So suppose my corpus has grown to 25 lakhs today, and I'm still continuing with the 10,000 SIP, for example, then that ratio is much, much lesser. So if the markets fall, I will not be happy that I'm buying units at a lower price, but I'll be sad because the value of the 25 lakhs have gone down, right? So it doesn't really matter. SIP is only a form of investing. If you feel that the risk reward is not in your favor and say you should be 20% equity and 80% debt, that is how you should align your even future investments. And when you increase your equity allocation, it should also get increased. So don't think that if you keep on investing in equities only, then you will get the power of compounding or you will get the benefit of cost averaging. What we're trying to do is that we're trying to get the benefit of cost averaging not on the basis of time, because markets would go up and down. We are hoping that eventually it will average out, but we're trying to average the cost by following certain parameters and tool indicators.
Right,
I
right.
hope that answers the question.
Yeah, I mean, pretty much. So Mehul Ajmera has the next line of question is, it's a bit of, an event-based question. What he's saying is based on his understanding, Fed is pumping a lot of money.
Correct.
As a result, markets are at all-time high, vis-a-vis what are the fundamentals that are floating around. So he's saying, should we exit by November, book profit and re-enter as, there's a thief of post-USA election. Further stimulus might be doubtful. So what do you think about it?
So thanks Mehul for attending. Mehul is my college friend and we spent really good time together. So thanks a lot for attending today. And I think it's $1 million question, right? I mean, that is what, like, again, you are asking me or looking at me as an expert, as if I know what is going to happen. I mean, it's anybody's call. No one predicted that COVID would come. And after it came and markets fell, I think there was hardly anyone who could have predicted the way market have really bounced back and it's given that V-shaped recovery.
Right.
I was today reading that the small cap index has almost gone up by 70% from its March lows. So, like I said, when you want to exit an investment or keep a track of your investments or align your portfolio, the weightages should be given on your internal conditions and product attributes. If at all you want to look at from a market point of view or from an external point of view, it should be based on a strategy rather than based on these events. So from 2013 to 2018 or 2020, the chart that I showed, obviously there were so many events that happened, right? Right from election of current Prime Minister, Raghuram Rajan, there was an exit. There was an exit by another RBI governor, and there are so many attacks that happened. 2016, we saw surgical strike, demonetization, GST, Brexit, Greece default, so many things. I mean, these news will keep on coming, but we cannot be sure that these are really going to impact the businesses in which we have invested. And ultimately, if we are really paying a fair price for the earning that those companies are demonstrating, I think we are home. So I think again, based on a call or an event, it would be nearly impossible for. I mean, if I say I know about it, I'll be saying lie. I'll be telling lie.
Yeah, I guess, event-based understanding or event-based allocation is not something that then you have to basically constantly monitor.
Yeah, I mean, if you look at CNBC and all these channels, they even make a event calendar, right?
Right.
In next 1 month, what's going to happen, and it's mind-boggling. Fed meeting, RBI meeting, and so on and so forth. So many events can happen, and if we try and track all those events, and see, even if I ask you, like, what happened in 2016, why did markets fell? It was a huge event, right? September, mein surgical strike had happened, and November, demonetization happened. But we might not even remember those events, when specifically when you just see the chart of why markets fell.
Right. Very true. Very true. So Amardeep has asked a question, risk-free AAA rate keeps on falling. So doesn't that make like equity more attractive, and hence paying a higher PE is fair? I think he's trying to take that Mickey out of you. So is there any matrix where we could take the risk-free rate into reckoning, maybe dividing the PE by risk-free rate? I think Saurabh, we should come up with an article on that.
So I am sure I know. So Amardeep is much more well read, and he's also following the similar kind of strategy that is built for his customers, and I think he's paying handsomely well. And like Warren Buffett has also said that every movement in interest rate has a far more reaching impact, and probably it can be uh, one way of looking at it as how we can incorporate risk, the returns on the interest rates, prevailing interest rates to our portfolio. Uh, Unfortunately, we've not been able to do it in our strategy, but I think it's a good thing. And again, we are on it. We'll try and backtest it and find and see how we can improve our strategy, or probably form an altogether different strategy, which can incorporate this indicator of current prevailing interest rates.
Right. Okay, so the last question is, sorry, so there are a couple of more questions. So there is one more question from Venkatraman Jayaraman. I think, if you want to take this question, you can take the question because it's not really related to the exit. What he's saying is LIC is informing that they want 4,000 crores of profit in equity. And so why other equity funds are not performing properly in April to June 2020?
So I mean, if you can cite out a particular fund, I would want to know. But I think funds have obviously bounced similarly back to in tandem with the indices. Like I said, that small cap index is up 70% from its low. Nifty is up from 7,800 to 11,600 today. So markets have gone up, and so has those funds. There are some funds which are not invested in Indian markets. Some international funds have gone up. So if you are specifically invested in a particular sectoral fund or a thematic fund, probably you might have an experience which is different. And I'm just not trying to demean. I'm just trying to guess. But otherwise, I don't see a reason why, in general, you see that the funds have not kept up with the market performance. It's almost in tandem.
Yeah. So the one more question is from Abhishek Mohta. So this is a very classic question. So you invest, market goes up, but the portfolio doesn't go up, and the market valuations go up. So what to do? Rebalance bhi kare when there is no profit in the portfolio. So this has happened in most of the mutual funds that he's saying, but I think this happens sometimes.
So again, see what happens is ultimately what underlying assets that you choose. Like we all just had a question where people said that they have not experienced that kind of return in their funds. So I mean, if I am tracking a PE strategy which is of Nifty, I would want to invest or have an underlying asset which is as close to that, right? If I'm tracking Nifty PE and investing in small cap, like whatever we did it in all our equity mutual fund holding and not in our PMS holding, right? We did not exit our PMS holdings, right? So it might be very difficult to look at a parameter which is only relevant to a particular section of market and then feel that it will be all pervasive and will be helpful in taking decisions in all segments of market. It doesn't really happen that way. So if it is close to it, then there is no reason why it should not go up. B, also again, if you feel that the issue was because of security selection, like I said, that you selected a security which is not as close to your index, and I know that Abhishek would understand this, but pardon me if I'm getting too complicated or using too much jargons. But if you are attributing this issue to security selection, yeah, again, I mean, it could have happened. Like classic case, Abhishek is saying that mostly it has happened with diversified fund, and that is the reason why we invest majority of our money in index funds. Classic case again, because we are invested with Marcellus. Marcellus has been a strong underperformer in last 3 months, right? And nothing wrong with it because they have not invested in few companies which have phenomenally gone up in last 3 months. So if we want to follow this strategy, probably one thing probably I missed to mention is that it's better to then have holdings which are as close to those indices and probably just mimic those indices. But honestly, there's no really right answer to it again, unfortunately. It might really happen. In fact, it has happened with one of our associates who was investing in Nifty ETF. And when we last exited, I think it was on 28th of July or whatever date it was. Eventually, when he sold, although he was invested in Nifty ETF, because of price movement and tracking error, his price of selling was lower than the price of purchase, even though market Nifty has actually gone up. So forget about diversifying. He had this experience even in Nifty ETF. So, I mean, there's no answer to it, honestly.
Okay, so he was just saying that, he was just talking about diversified mutual funds, most large cap funds, which are good names. So you covered that in the ETF part.
I read that.
So Dr. Lalit is asking, equity has not performed for the last 5 years in comparison with debt. Do you agree with that?
Yeah, I mean, if you look at only that is the whole point. We only look at one particular point. In last 5 years, we are looking at only one data point where investment was done in 2015 and we are exiting in 2020, right? If you look only at one data point, it will always be favorable to one particular asset class or one particular investment. That's
Right.
why the idea is to look at the rolling returns. And the graph which I showed, where the difference between average return if you do an SIP with STP was all based on rolling return. So just to arrive at a conclusion based on one data point is not what will really work for us. So we have to make sure that there's enough data points which can be looked upon and assimilated before we arrive at that conclusion. Honestly, there should be no reason why on a rolling return basis or over a 5-10 year basis, why equity should not give a higher return than fixed income. For every business to sustain, right? I'm just talking from a very, very basic and layman's perspective that if I'm doing a business, then I have to generate a return which is higher than the cost of capital that I'm borrowing. Otherwise, I'll not remain in business, right? So the cost of equity is always higher than the cost of fixed income. So eventually, in economic parlance, there is no reason why equity should not give a higher returns than fixed income.
True that. Very true. So, Saurabh, I think there are a lot of chats and there are a lot of nice comments, excellent session, awesome, crisp and concise, brilliant. I mean, this really, really great. I mean, there are lots of them. So before that, before I give my final conclusion remarks, I would really like, the bonus that is Mukul is here. Hi, Mukul.
Hello, hi everyone. Hello.
So I just want you to, give your final comments and close the session for us today, please.
So while the topic has been, when do we exit? And I think this is a very, very important and relevant question that each one of us, including me, myself, and all the people who are in the session right now, every investor has this question in respect to any investment that we make, predominantly when it comes to a riskier asset class like equity and mutual funds, that when do we exit? Because as Saurabh mentioned during the session, it has always been the scenario that the investment makes returns. There are big holdings that investment ने 20% रिटर्न दिया, 25% साल का रिटर्न दिया, 10 करोड़ बन गया, but कितने investors को वो पैसा मिला, कितनों ने बना पाया, that's always questionable. And much of it has to do with the exit strategy. While what time are we choosing to enter is important, it is equally important when we are exiting, because if we don't exit, the profits get evaporated. Like Saurabh showed in that one slide, where in over a 10-year period, 6 lakh ka profit tha 8 saal baad, and then after 10 years, sab gayab ho gaya. Yeah. So I hope it has been a great session, a relevant session to all the viewers. I really appreciate every one of you that you have taken out time on this Thursday evening and listened to us, listen to what Saurabh has to say from all the experiences that he has gathered by meeting hundreds of influential, and very, very intelligent, knowledgeable people and talking to them, and in this and attending many, many industry events, from where he's gathered all these insights and he shared with us today. I would like to really thank Venkatraman, Amit, Mehul, Amardeep, Abhishek, and Dr. Lalit for asking relevant questions, and I guess asking questions is so important because while others may not ask, but someone who's asking the question is actually enabling and helping other viewers also to know about certain aspect which others wouldn't have even think about. So I really thank all of all the participants who have asked the questions. Thank you.
Yeah, and we thank you, for the wonderful closing statements given by you. We'll hope to hear from you now.
Thank you so much.
Okay, see you.
You write to us if you have any queries, and more than happy to answer those. Yeah, we have made the recording. We'll send the recording to you. It will be put up on YouTube, and we'll send the link to you.
Absolutely.
Thank you. Thank you so much. I will complete the session. Thank you.
Thank you. Thank you, everyone.
Bye.